One door always opened for end-to-end business solutions. One place to help you exceed expectations. Welcome to The One. For further inquiries, visit www.investment-one.com to get started. Welcome to The One. One place of possibilities. A niche for financial success. The one place where your dream is the priority. From wealth management and financial advisory to retirement planning, a place with a dedicated team with various expertise guiding you to financial freedom. One door always opened for end-to-end business solutions. One place to help you exceed expectations. Welcome to The One. For further inquiries, visit www.investment-one.com to get started. Welcome to The One. One place of possibilities. A niche for financial success. The one place where your dream is the priority. From wealth management and financial advisory to retirement planning, a place with a dedicated team with various expertise guiding you to financial freedom. One door always opened for end-to-end business solutions. One place to help you exceed expectations. Welcome to The One. For further inquiries, visit www.investment-one.com to get started. Welcome to The One. One place of possibilities. A niche for financial success. The one place where your dream is the priority. From wealth management and financial advisory to retirement planning, a place with a dedicated team with various expertise guiding you to financial freedom. One door always opened for end-to-end business solutions. One place to help you exceed expectations. Welcome to The One. For further inquiries, visit www.investment-one.com.
To today's webinar, titled Navigating 2026, Nigeria's Economy and the Road Ahead for Investors. As we stand at the threshold of new economic cycle, Nigeria's investment environment continues to evolve, shaped by policy shifts, global influences, and emerging opportunities across key sectors. In such an environment, clarity, foresight, and informed decision-making are more important than ever. Today's session is designed to provide you with a deeper understanding of the forces influencing Nigeria's economy in 2026, while exploring practical strategies to position your investment for resilience and growth. Through expert insight and thoughtful analysis, we aim to equip you with the tools needed to navigate uncertainty and identify sustainable opportunities. Thank you for choosing to be a part of this important conversation. We look forward to an engaging and insightful session. And today with me, I have seasoned professionals who will be speaking to us about the market from, macroeconomic perspective, market perspective, and even tax perspective. Today with me, I have Tolulope Adesanya, Head Financial Control Investment One, Ifedolapo Peter Ajakaye, Head Wealth Management, Mustafa Alao, Head Research, and Oladipupo Dauda, Head Treasury. So we'll be going right straight into this session, starting with Mustafa. So from a macro perspective, what are the key assumptions underpinning your 2026 outlook for Nigeria, and what do you think are the potential downside risks in your assumption?
All right, thank you very much, Amanda. Good morning to everyone listening. So, when we assess our outlook for 2026 for Nigeria, we look at key indicators such as the external sector and what factors are going to shape that. We also look at Nigeria's growth, and we look at other key indicators like inflation, how the currency is going to trend over the year. And with the aforementioned, which are some amongst a few others, we're largely positive, right? So if we start with how I started, so the external sector, of course, a key element of that is with regards to oil prices. The oil sector, although it's about less than 4% in terms of, how much it constitutes to our GDP, at least as of Q3 2025, it contributes about 57% of our exports. So it's quite key and cardinal to our economy. And if you look at that market, there is generally a supply glut. You see that supply is not, or you say it's moving at a faster pace than demand. And because of that, expectations is that oil prices will be suppressed. However, we've seen that with recent geopolitical tensions, that has helped to boost crude oil prices. And our general expectation is for that to hover around $62 per barrel in 2026. So if you now take that and you compare it with what the budget, and now I'm moving into the fiscal aspect. When you compare it to what the budget assumes about $64.80 per barrel, right, or less than $65. You see that there's that deficit there. So we expect that, we should see, a larger deficit than the current projected 23-24 trillion naira. So we also look at consumer spending, and this ties into our inflation expectation. Our general expectation is that inflation on a year-on-year basis trends down. As we speak, as of December 2025, it came in at 15.15% year-on-year. In 2026, by the end of the year, we expect it to come in at between 10 to 13% on a year-on-year basis. So with that downward trend in inflation, we expect that this will help to positively impact consumer spending as it improves purchasing power. And we expect that will be seen in the consumer goods sector, right? And with us seeing, increased spending, this should help when you look at the GDP computation, consumer spending aspects, right? So from a consumer spending aspect, we expect that this will help inflation. And our expectation for GDP growth in 2026 comes in at 4.3%, which is just slightly shy of the IMF's a little bit more positive expectation of 4.4% for 2026. So these, like I said, amongst others, are some of the factors that we look at that shapes our expectation for 2026. And just as a summary, the general expectation is that we are more positive than last year. We are seeing that a lot of the reforms, that the present administration brought with regards to the Naira, with regards to fuel subsidy, we're seeing some of the effects now, just like in the Naira, for example, right, with the, liberalization of the Naira, and us seeing that essentially boost investor confidence in Nigerian assets, thereby allowing increased level of FPI inflows into the country. That has helped to stabilize the currency and also helps with companies in their forward guidance. So we expect that there will be stability, but we put a little asterisk there So it's a fragile stability, and we are hoping to see that transition into a growth phase, which we are not yet in. We're not there yet, but we're in a stage of fragile stability, and the general macro landscape is looking a bit more positive than it was last year.
Okay, thank you for that wonderful submission. And I wanted you to identify the downside risk, right? Which of these your assumption poses a risk on, Nigeria's economy from macro perspective, budget perspective, revenue generation, and all of that? I know you mentioned something about oil, with oil, trending downwards. I wanted to know what your outlook is for oil and its impact on budget and even, global inflation. Just espouse more on that.
Okay. So let me pick up from the points you raised. So with regards to oil prices, as I mentioned, our expectation for 2026 is about $62 per barrel. Okay. Now that is below the 2026 appropriation bill's projection of $64.80 per barrel, or between that and $65 per barrel. So that already is an issue there, because it's going to have an impact on the projected revenues. So definitely with us seeing, the level of supply in the crude oil markets rising at a faster pace than demand, and if we see cartels like the OPEC bloc, continue to churn in more barrels into the seas, should we see rig counts in the US continue to rise? Should we see a faster than expected resuscitation in the Venezuelan upstream crude oil environment, and other upside risks, or to the crude oil markets? We could see that this could further hinder Nigeria's growth for 2026. Just to make it a bit more practical for investors, if we see crude oil prices go at, say, mid-50s, or slightly below that for an extended period of time, that is going to definitely have a negative impact. So that is definitely a downside risk, like you highlighted. Of course, another one, which is a lot of people see as like a boogeyman, during the pre-election year, is potential pre-election spending, right? Yeah. So, how much is that going to have an impact on inflation? So, although historically, when we look at the data, it doesn't necessarily suggest that there's a significantly higher level of money supply in the system during the pre-election year. Because if you look at broad money supply, M3, for example, you see that during the pre-election years, it doesn't necessarily significantly spike. However, this is something that we should still consider as a risk, right? When you're doing investment research and you're doing a projection, especially within the African context. And an example I like to bring is in Kenya in 2017, Kenyatta and Odinga, right, when they had that rerun of the election, and the negative impacts that had on the sovereign bonds, right, the Kenyan Euro bonds, the negative impact. So there's that risk that is still there, and I think it's going to be a lot more curbed than it was like in the 2023 election, to be honest, considering the reforms that have been put in place and the transparency tools that have been facilitated. I think that pre-election spending is going to be a little bit more tamed than it was in 2023. But these are some of the risks that could negatively impact the outlook for 2026.
Okay, thank you so much. And before I move to Dipo, I would want to, with the stability which we've seen in the foreign exchange, yesterday it closed around, I think, 1,354 naira at the official window, and inflation moderating to 15.15% in December of 2025, right? Would you describe Nigeria as being in the recovery phase or a fragile stabilization phase? What would you, where would you place Nigeria in this?
So I think that like I put it, Nigeria is in the fragile stabilization phase, right? Okay. So yes, there's some improved stability, right? But the pillars that are supporting that stability are still not solidified enough yet for us to be able to transition into that growth phase properly. Do you understand? So there still needs to be a sustained, and consistent implementation of the reforms. If you start to see reversals, then that's going to be that's going to have a negative impact on the economic outlook, right? So if we look at sectors like, you mentioned the Naira, for example, right? So of course, with things like the B-matching system with FMs coming into place, things like improved transparency, which is allowing a lot of FPIs to come in, thereby allowing the CBN to have increased liquidity to support the Naira like we've seen. We've seen FX reserves now above 46 billion US dollars, so I think that's one thing that is very, very key to be able to sustain the level of stability that we've seen and even improve on it, is that the reforms are kept, okay? That is very, very important, because if they're reversed, they're going to see a lot of reversal in foreign investor participation and interest, right? Also, if you look at, what is happening around the globe as well, you find that in advanced economies, the general outlook is for there to be lower interest rates, right? And this presents like a carry trade opportunity, for foreign investors looking at emerging markets as well as frontier markets where Nigeria happens to fall under, okay? So, and if you look at the candidates, like perhaps maybe Kenya, South Africa, Brazil, Nigeria, based on the data which we assessed in Investment One research, presents a very attractive carry trade opportunity, relatively. So I think that, the outlook for the Naira is that, we should still continue to see some stability. We are seeing continuous and improved interest from foreign investor. Foreign participation is improving. We think that with some developments that are going to happen over the year in the markets and relating to the markets would even boost that further. So we're expecting to see, as announced by Dangote Refinery, for example, a potential listing. I think that's going to boost sentiment. In addition to that, we're expecting to see that, just general foreign investor sentiment towards the Nigerian market is better to improve, with Nigeria being included into certain indexes like the JP Morgan Bond Index, for example, and one data that we looked at was the credit default swaps trend, over the last few months, right? So essentially contracts that, the CBN issues for, credit default swap risks. And we saw that's trending downwards. And what that signifies is improved interest, right? Or improved confidence in the Nigerian market. So I think that with all these different pieces put together, it shapes a positive outlook for the stability of the currency, right? Not necessarily a positive outlook for the currency rate in of itself, but for the stability of it. Just to put a number to it, as we espouse in our outlook reports, which people can access, our investment research strategy reports, our expectation for the Naira in 2026 is for it to come in at between 1,330 Naira to 1,430 Naira per dollar by the end of 2026. So this is the general outlook with regards to the Naira.
Yeah, thank you so much for that beautiful insight. To Dipo, I think Mustafa, I think one of the key themes which you mentioned is sustainability, and that would, drive my question to Dipo. How sustainable do you think the stability of the currency would be? Are we going to continue to see this appreciation? And what would you be watching, or what are you closely monitoring for signs of early stress or maybe a reversal that we could see in the course of the year?
All right, thank you very much. So I think most of us said quite a lot. For exchange rates, the view is that Naira should, at least for this year, we are quite positive on the local currency, and it started off for the artificial market above 1,004. Today it's 1,350, as you reported earlier, and the trend we expect that trend should remain for a better part of of the year, going into the end of the year, we don't see reasons for capital flow reversal. If anything, this last year, for example, we started seeing significant FPI inflows. I think for last year, FPI inflow was in excess of $22 billion, and that has already started again this year. If you look at the OMO auctions, bond auctions for January, the level of subscription shows that the appetite for Nigerian assets, even Naira-denominated assets, is quite robust, and the expectation is that will persist. Mustafa talked about carry trade. If yields are coming down globally, yields are expected to come down globally, and you have decent return in Naira, your fear of devaluation of the local currency is minimal. If anything, you expect that the local currency continues to appreciate. So that gives impetus for foreign portfolio investors to come into this space. So for us, we feel that going to the 2026 financial year should be positive. Outlook for FX target between 1.3 and 1.430, 1.330 and 1.430, and to the risk that we see. So I guess Nigeria remains a petrodollar economy, though every government comes in and try to talk about diversifying the economy away from crude oil, but as it is, we still remain a petrodollar economy, and crude oil prices definitely would remain a major risk factor that we continue to assess. So hopefully we don't go below the $60 mark, and because if that happens, you expect that a lot of these foreign portfolio investors might become agitated and you start seeing capital flow reversals. But if we don't see crude oil going below the current levels, which we hopefully we don't expect, I think the headwinds are minimal. Election year, yeah, but the increment seems to be pulling its weight, and a lot of reforms that, yeah, consumer, it's a bit harsh on the consumers, but again, people are starting to see the effect of those reforms. So hopefully, if we don't see so much political tension, maybe security is also an headwind, most especially the insecurity up north. If that is also managed, we feel this year definitely should be a positive one for major markets, fixed income, equities market, because the moment you continue to see this foreign portfolio inflows goes into both the fixed income market, it brings down the rates on the FX side, you continue to see strong performance in the all-share index. So those factors, crude oil prices, insecurity, election year, are the major risk we see, but nonetheless, we still hold a very positive view for this financial year.
Okay, so the accretion to the external reserve, you expect that to continue, and do you see a particular number you think we may close the year at? Yes. Currently around $46 billion US.
Okay, so yeah, I think I think one of those things that we also need to look at, $46 billion external reserve, but what is the net reserve? But irrespective of the net, because actually the net reserve is the major number, but most times we tend to look at the ballpark figure of what's the external reserve of the country, and with the level of portfolio inflows that we're seeing, I think we expect that hopefully we should cross the 50 billion mark, which also will give further confidence as to the local economy, the level of interest that the foreign portfolio investors have in the market. And hopefully along the line, with these reforms continue, we start to see foreign direct investment as well, because again, it's one thing to have foreign portfolio investment, but you need to also grow the numbers on the foreign direct investment side. So hopefully we start to see more of that, and the government pushes to increase those numbers, because it's not just the portfolio inflows that you want. You also want more foreign direct investments into the country.
Thank you so much, Dipo. And now to Tolu, still on the foreign exchange, the currency, right? In previous years, corporates had to deal with foreign exchange volatility, especially in 2023, where we saw the reforms made in that space, right? And in 2024, you still saw some sort of, FX losses on some of their books. But in 2025, we saw corporates rebound strongly, especially, names in industrial consumer goods, right? I think it was a good year in terms of the foreign exchange with the appreciation which was seen and the relative stability also seen in the course of the year. So I wanted to know, in your view, do you think that recovery or that rebound is going to be sustained in 2026, or do you think it's a temporary rebound in earnings for corporates?
Okay, thank you, Amanda. Good morning to our viewers. Like Amanda said, in 2023, when the reforms FX, the intervention was, FX was deregulated, and the petroleum sector was also, the downstream sector was also deregulated. We saw a huge depreciation in the currency. A lot of companies, especially companies that have loans in foreign currency, they recorded huge losses. And like you said, it's recovered over the years, in the last 2 years. Going by what Mustafa and Deepa already said, if the outlook is to see it stabilize, then we expect no impact on the financials. Mm-hmm. That means, I also expect, apart from having a stable currency throughout the year to the end of the year, we also expect that companies will have learned from what they saw in 2023 and try to edge FX risk. We'll see some already edging FX risk to ensure that the volatility does not impact them significantly. But overall, the outlook for the Naira is a bit stable, so we do not expect to see negative impacts on foreign exchange in the books of companies.
Okay, so thank you so much, Tolu. So what financial risk do you see in terms of FX, interest rates, or liquidity that could pose greatest threat to corporate balance sheets in 2026? And how should firms be prepared to manage them?
Okay, this is a pre-election year, and what usually happens around this time is that you see a lot of spendings. And we've been saying that inflation is trending downwards. I don't really think that the spending would drive inflation upwards. But if we see inflation inch up a little or then reverse from where it is currently, this may sort of spike interest rates again. Although we've not really seen reduction in interest rates as much as we saw in inflation. So we still believe that lenders are still quite aggressive. They are not dropping rates as we expect. So most borrowers, especially manufacturers, although there are interventions from the government, we are seeing mortgages, interventions from Bank of Industry, where you can access funds at cheaper rates. But for people that really cannot access those kind of windows, they will still have to go to the regular commercial banks, microfinance banks, and even some individual lenders. So we've not really seen contraction in interest rates when it comes to lending. So this year, I still see high finance costs in the books of companies, and we know how this will affect cost of goods and services. So for pricing of goods, and competition is not, I think the interest rate environment, we've been used to it in the last 2 or 3 years. So it's going to be stable. I see stability.
Okay, thank you so much, Tolu, for that, for the insight. And to Ife, quick questions. So far this year, are clients more focused on capital preservation or return maximization this year?
Okay, so this year customers are demonstrating more interest in capital preservation while still seeking competitive return. There's a lot of investment education from Securities and Exchange Commission and investment houses on how they can invest in secured instruments. So you see customers are not really invested in Ponzi schemes and risky assets. So they are more concerned with securing their principal investment. So most times, sometimes they want to reclassify. They want to rebalance their portfolio from a fixed income portfolio to equities and alternatives. So they are more concerned about capital preservation at this time.
Okay, so before I come back to you, I wanted to just quickly ask Deepo, given the current yield levels and moderating inflation, how attractive are Nigerian fixed income instruments today, and where along the yield curve do you see the best opportunities?
Okay, so for today, I think the yield, if you look at it relative to inflation, there's a positive real return, which is one of the fundamental thing to first and foremost look at. But in all, with yields on treasury bills closer to the 2021 levels, those yields have been coming down. We had two auctions. We had two auctions in January, and in both auctions, stop rates closed lower than the previous auction, and owing to the level of interest seen. Also for bond auctions, we had one bond auction in January, and the market is trading significantly below the stop rate at the auction. So expectation is that we might continue to see yield trend lower, though I also do not expect that the monetary policy regulators will allow yields to fall too fast, so that, again, that doesn't lead to reversals, maybe people taking capital gain on investments, or foreign portfolio investors taking capital gains. And so I think yields will still remain pretty attractive in the sub 20 levels, most likely. I think yields, I expect that treasury bills yields to come in below 20 as we move along. And there's a MPC meeting this month. Market is expecting that we might see the first rate cuts. If you look at other markets, at least for example Ghana and some other African countries, we're seeing rate cuts, but we haven't seen that in Nigeria. So market is expecting that. If you look at where inflation is and where the anchor rate is, I think market will not be surprised to see a rate cut in the first MPC meeting for the year. So where to play along the yield curve? I think as it is today, maybe you want to play closer on the longer end of the yield curve. If your view is that yields will continue to come lower, you want to lock in decent yields for longer term. So as against buying a 90 days investment, you want to do a 1 year investment if you need to do money market investments, or maybe the current set of 2033, 34 bonds that are being reopened. Those are trading close to 16%. So 2033 is a 6-7 year bonds at 16% levels is quite attractive. So I think those are the levels along the curve. Anywhere you play along the curve is attractive, at least if you look at it relative to inflation. But again, if you have funds that can stay for long term, I think it would be ideal to lock in those yields now, because again, if the level of reforms we are seeing, and hopefully those level of reforms continue post-election, I don't see expectation, unless maybe the other factor of crude oil prices that materializes. But other than that, with the level of reforms we are seeing, I'm sure over time they'll be looking to start pushing growth. And one of the ways to push growth is lower yield, so that cost of doing business reduces. So if those assumptions are right, then maybe it's better for you to start to look at locking in decent yields for longer tenor than you would normally do, because with time you might just start seeing yields come lower.
Okay, thank you so much. I smiled because of your answers, right? Because my next question was going to be, what do you expect from the Central Bank of Nigeria in their next meeting in this month? I think you did answer that. So I would like to know what informed that expectation. Maybe just highlight it for the listeners.
Okay, so what's driving that view? Some will have even expected that we should have a rate cut last year, but that didn't happen. One thing you have to give kudos to this current management of the central bank. They've been spot on, and which is part of those things that has engender confidence. Look at the sovereign issuance, Eurobond issuance done last year. Look at the magnitude of oversubscription we had. So they've shown that they are not rushed. They don't rush to take decision. They even sometimes maybe play behind the curve, like, okay, this market will have expected that, okay, at this point you do it. They wait and see and be sure that. So everything lines up for us to have a rate cut. I'm sure personally, if you don't see a rate cut, maybe market that might even be negative, because start asking questions. What else do you need to see before we start seeing these rate cuts? So personally, I feel that we should have a rate cut this month, and hopefully we get that, and that continues to engender confidence in the markets.
Okay, thank you so much for the insight and to the panelists so far. And if you have questions, you can drop it. You can send your questions in the chat so that we can answer them in the course of this discussion. We'll go on a quick break. Please stay with us.
Welcome to the one place of possibilities, a niche for financial success, the one place where your dream is the priority. From wealth management and financial advisory to retirement planning, a place with a dedicated team with various expertise guiding you to financial freedom. One door always opened for end-to-end business solutions. One place to help you exceed expectations. Welcome to the One. For further inquiries, visit www.investment-one.com to get started. Welcome to the one place of possibilities, a niche for financial success, the one place where your dream is the priority. From wealth management and financial advisory to retirement planning, a place with a dedicated team with various expertise guiding you to financial freedom. One door always opened for end-to-end business solutions. One place to help you exceed expectations. Welcome to the One. For further inquiries, visit www.investment-one.com to get started.
Welcome to the second part of this webinar, and I'll be starting with Mustafa. Quick questions. Quick questions. I mean, equities, fixed income, or both?
Well, in portfolio management, if we have a client, we first give them an IPS, right? It's a policy statement. So that question, it's quite subjective.
Exactly.
Because it depends on a multiplicity of factors. Ethical factors, risk tolerance, and others. So I would say, and I'll answer it in this manner, if you are risk averse, right, what would likely happen is that a larger percentage of your portfolio will go to what is seen as safer assets, like fixed income, right? And if you are more risk inclined, then you have a larger percentage of your portfolio tilted more towards equities, right? And I'm just sticking to the two asset classes you mentioned. However, due to our general outlook, I would say that due to increased stability, a larger percentage can be shifted towards equities this year than last year. Okay, so because our general expectation for the different macro indicators is that there should be improved stability, I think the risk premium on Nigeria, has been suppressed, to an extent. So I would say that you can have an improved level of allocation to equities, So, so still both, because obviously fixed income offers that, security, capital preservation, and equities, a little bit more volatile, but due to our, expectation for improved stability in 2026 compared to 2023 and 2024, right, you can have an increased level of allocation to equities than you would have done in those last two previous years.
Okay, thank you, Mustafa. So, Ife, how are you advising clients to allocate across equities, fixed income, and even alternative assets?
Okay, so in advising our clients, what we actually do is we profile our clients. So just like you mentioned, so we try to look at their risk appetite, objectives, and then the period of investing. I mean, one cap does not fit all, right? And so let me give an example of a young investor who probably just started work and has, say, 20 years, 25 years to work. And my assumption is that his risk appetite is high because he has more time, investable period, right? And he's probably investing for retirement. In that example, I'll probably advise 50 to 60% in equities, 20% in alternative investment, and then a little bit, 20 to 30% in money market. So he has time, he staggers his purchases, he tries to create a standing order over time, and then he's going to watch his wealth grow as time goes on.
Thank you. So for high net worth individuals and then retail investors, what common behavioral mistakes have you seen in the market thus far, and what should investors do to avoid such mistakes?
Okay, I will
especially
start
in
by
2026.
Okay, I'll start by saying lack of diversification. Most times, investors just invest in a particular asset class, or invest. So, for instance, if they invest in the equities market, they invest just in the banking sector. So, we encourage clients to diversify their portfolio and then invest in different asset classes based on their risk profiling and other factors earlier mentioned. Another thing would be timing the market, and this is really for alternatives and equities. You find out that some investors are trying to time the market, want to buy when the market is high and do short-term highs and lows. So timing the market isn't good. Invest in fundamentally sound instruments, stocks, and then and watch it grow. And then the third thing would be overconfidence. Some people think they understand the market even better than the professionals. So sometimes they buy when they see there's a rally, they come in and then they get burnt. And that way they would lose a portion of their investment. So really what we advise is engage investment professionals. We are here to give you recommendations per time and advise you on the best asset class to invest in per time.
Okay, thank you so much, Ife. And away from markets, investment, and all of that to Tolu. Taiwo Oyedele, the chairman of the Presidential Committee on Fiscal Policy and Tax Reforms, has pleaded a couple of times to individuals to file their annual tax return. He had mentioned that it's a legal obligation on both individuals and employers. But many people believe that it is the responsibility of their employers, and they just take it with a pinch of salt. From your own view, I would like to get more insight on that, with seeing that the deadline for filing it is 31st of March 2026, especially for individuals.
Okay, thank you. So generally, Nigerians are not really used to being taxed. It's not really part of our culture. what the committee is bringing on board is not strange globally. It's just what we are used to in this part of the world. So as an employee, a fully paid employee, the duty to remit your taxes, deduct and remit, it doesn't just lie solely with your employer. The government expect that you make, it's possible that you make monies outside your employment. Even if you're not physically engaged, you can have income from inheritances, like maybe your father passed on a building to you in Ikoyi. You have shares in companies transferred down to you where you have income, where you generate income from. This kind of income is subject to tax. And how do they get to collect the taxes from you? If they are not deductible at source from where you're getting it from, you're expected to self-declare. And that is the window that closes by 31st of March. For your employer, it's 31st of January. They file in your payee and ensure that all your taxable benefits are taxed and remitted. However, it's expected that you now personally goes to the personal income assessment window to self-declare what you've earned during the year. You get the necessary reliefs and you get the final computation of your tax payable, which you are supposed to remit. But people have been, they're not taking it seriously. I'm not sure people are taking it seriously. But I really don't know what the response of the government will be or what the punishment will be. But I know that all they need to do now is enforcement. And how do I see them come up with enforcement? It will get to a point, I don't know if it's in 2026 or later on, where for you to assess anything from the government, you may have to present your tax clearance. And tax clearance, unlike before, that used to be issued once your HR is able to remit for you, you may not get tax clearance if you've not done your personal income assessments. And I think that is where we'll get to. For instance, you want to go and get your passport at the immigration office and they ask you, where is your tax clearance? So I think they will start with enforcement, although we have the deadline as 31st, but enforcement has to commence before we start seeing the capital punishments.
Okay, thank you so much, Tolu. Taiwo Oyedele has pleaded, and now Tolu has given us more insight to this. So I think it's time for us to take it serious and do what we're supposed to do, seeing that it's a legal obligation on us. And I know Mustafa already answered on equities, fixed income, or both. Dikpo, equities, fixed income, or both. No reasons for your answer, but what would you do? Just quick, one answer.
Well, I think it's still both, definitely. But like the earlier two speakers talked about, you have to look at risk tolerance. But I think this year, the equities market most especially, is going to. Last year had this very strong performance, and I expect same this year. So maybe personal allocation, I think will also increase my allocation to equities this year as against relative to what I did last year, because quite positive on the market. And fixed income, try as much as possible to lock in decent yields earlier part of the year, because sometimes you see people say 16% on bonds. These were bonds that are traded as high as 22%. But again, even at 3%, people will still trade bonds. So 16% might look low relative to when you start looking at those previous numbers, those previous highs. But I'm not saying that it's not possible to have yields back up slightly along the way this year. But if those risk factors do not materialize, I still feel this 17% on bonds and 20% on T-bills is quite decent.
All right, thank you so much, Dikpo. Mustafa, if you were to define or give an investment theme for the year to investors, what would the theme be for 2026? Your outlook is quite positive, right? I think we only were able to identify one potential downside risk. But for investors, in terms of return, what would be the theme for 2026?
In terms of return,
Yeah, what's the theme for the year?
I think it would flirt with last year's return. So, but that's just it. You should understand. So, if I'm just to put figures to it, our outlook for the equities markets, which we talked about, last year it did 51.1%. This year, our expectation is 35%. Okay. So, I mean, last year's gains were blockbuster, right? They were blockbuster gains. You know, they were similar to the large gains that we saw on gold, for example. Gold did 60% plus. All right. So last year was, was quite good. You know, this year, we're a little bit cautious, with that, but 35% is still quite good. So I would say it's, the theme is that it would flirt with, mirroring last year's performance, but that's just it. It's just going to...
So a leap, quantum growth, or what kind of growth?
Quantum growth.
Okay.
Well, I mean, see, we need to also, emphasize the fact that despite, the positive outlook that we might have on a lot of these indicators, risks are still there. Okay, those risks are still there. Let's not forget, like I mentioned earlier, we are in a pre-election year, right? We're in a pre-election year, and we might start to see in the equity market some sell-offs, right? We'll start to see negative sentiment. We'll start to see, adverse investor action in the markets, especially as we move closer towards that season. So we need to take that into consideration. However, our outlook is positive, and it's very important for investors to be cautious, as they have that at the back of their mind. And I will leave it at that.
Thank you so much, Mustafa. So we'll be checking the chat to answer some of the questions that are there, if we have any questions. So while we check the chat, one last question for Getolu. If 2024 was a year of survival, right? 2025, year of stabilization, and 2026, what would you define the year to be for corporates and maybe investors?
So it should be a year of success because, like I said, I expect that companies will have learned from the extremes we saw. The FX depreciation in the currency, high interest rates, they were all huge lessons for for companies. So I expect that if 2024 drilled us that much, 2025 brought stability, then 2026 should be a year where all the lessons you've learned should materialize, should lead to success for you.
Oh, thank you so much. So maybe consolidation and then success. All right, thank you so much to everyone on the panel today. Thank you for the insights. I'm pretty sure everyone on this webinar today has picked one or two things from the webinar. And on behalf of everyone at Investment One, I extend our sincere appreciation to each and every one of you for joining us at today's webinar. To our distinguished guests and valued participants, your presence and active engagement significantly enriched today's discussion. We are especially grateful to our esteemed speakers for sharing their expertise and perspective. We also commend the organizing team for this, for their dedication and meticulousness to ensure seamless execution of this event. We encourage you to the audience, we encourage you to apply these insights in shaping sound investment decisions in the year. And at Investment One, we remain committed to supporting you with trusted guidance and innovative solutions on your investment journey. Thank you once again for your participation, and we look forward to welcoming you to future engagements. Thank you.
Thank you very much.
Thank you.
Welcome to the One place of possibilities. A niche for financial success. The one place where your dream is the priority. From wealth management and financial advisory to retirement planning, a place with a dedicated team with various expertise guiding you to financial freedom. One door always opened for end-to-end business solutions. One place to help you exceed expectations. Welcome to The One. For further inquiries, visit www.investment-one.com to get started.